Warren Buffett is obviously one of the best investors to ever do it, and truly, when I was doing my MBA and PhD studies, I just read everything that I could, not only on his tactics, but on him specifically. What I like about Warren Buffett is that he tells it like it is and he keeps it very simple. Investing does not need to be complicated, but the more that somebody is trying to make it seem complicated, the more they're probably trying to trick you. So be careful. If you want to invest like one of the best to ever do it, here are the 4 rules that you need to follow. My name is Nolan Govea, my students call me Professor G, and I made this channel to make investing simplified. Rule number 1 is to stick to businesses you understand.
Old-fashioned belief that I should expect to make money in things that I understand. And when I say understand, I don't mean understand, what the product does or anything like that. I mean, understand what the economics of the business are likely to look like 10 years from now or 20 years from now. I know, in general, what the economics of, say, Wrigley chewing gum will look like 10 years from now. The internet isn't going to change the way people chew gum. It isn't going to change which gum they chew. If you own the chewing gum market in a big way, and you've got Double Mint and Spearmint and Juicy Fruit, those brands will be there 10 years from now. So I can't pinpoint exactly what the numbers are going to look like on Wrigley, but I'm not going to be way off if I try to look forward on something like that. That evaluating that company is within what I call my circle of competence. I understand what they do, I understand the economics of it, I understand the competitive aspects of the business.
So he's saying that you need to identify what your circle of competency is, and you need to stick to it. If you know a lot about the athletic apparel market, then you're going to know all the intrinsic value and competitive advantage of something like Nike versus Lululemon. People always ask me, should I invest in this crazy AI stock or should I invest in cryptocurrency? Well, if you're asking that, then you probably don't know as much about it as you should, because if you did, you probably wouldn't be asking me if you should invest in it because you'd understand it.
Defining your circle of competence is the most important aspect of investing. It's not how large your circle is. You don't have to be an expert on everything. But knowing where the perimeter of that circle of what you know and what you don't know is, and staying inside of it, is all important. And if I don't understand something, but I get all excited about it because my neighbors are talking about it, stocks are going up and everything, I start fooling around someplace else, eventually I'll get creamed, and I should.
So now, while you definitely need to stick to what you know, you also need to be ready to pounce when the time is right. Next rule is all about taking advantage of the golden opportunity.
Opportunities in life have to be seized. We don't do very many things, but when we get the chance to do something that's right and big, we've got to do it. And even to do it in a small scale is just as big a mistake almost as not doing it at all. I mean, you've really got to grab them when they come. Because you're not going to get 500 great opportunities.
Even in my lifetime of 28 years, there's really only been 3 amazing stock market opportunities: the dot-com crash, the global financial crisis, and the 2020 stock market crash. So roughly once every 10 years.
Are mistakes of omission and not commission. I mean, it's the things I knew enough to do, they were within my circle of competence, and I was sucking my thumb. And that is really, those are the ones that hurt. They don't show up anyplace. I probably cost Berkshire at least $5 billion, for example, by sucking my thumb 20 years ago or close to it when Fannie Mae was having some troubles, and we could have bought the whole company for practically nothing. And I don't worry about that if it's Microsoft, because I don't know it. Because Microsoft isn't in my circle of competence. And so I don't have any reason to think I'm entitled to make money out of Microsoft or out of cocoa beans or whatever. But I did know enough to understand Fannie Mae, and I blew it. And that never shows up under conventional accounting. But I know the cost of it. I passed it up. And those are the big, big mistakes.
Warren Buffett says that you need to do a lot of research. You need to know everything inside and out about what you're about to invest in. But more importantly, you need to take and seize the opportunity as soon as you see it. He uses the analogy of baseball, and just like baseball, the perfect pitch could either be one that's thrown right down the middle and you could hit it out of the park, or you could swing too late and miss for a strike. Now, rule number 3, and this is the one that made me the most amount of money. But first, I want to thank and introduce the sponsor of this video, Delete Me. Did you know that your personal data is sold online by data brokers? You have the right to stay private and protect that data. Delete Me is a hands-free subscription service that will remove your personal information that's being sold online. Right now, it's becoming all too common of this trend of data breaches resulting in the loss of personal data control. 1/3 of the US population's background info is now public. Delete Me's privacy experts remove your personal information such as phone number, address, and other important information from hundreds of data brokers all year long. I really enjoy that the customers can make custom removal requests. We all do a lot online, specifically in finance and investing, so it's just so smart to have an extra layer of protection. Get 20% off Delete Me US consumer plans when you go down to the link in my description, which is joindeleteme.com/professor, and use code PROFESSOR at checkout. So the third rule from the Oracle of Omaha is literally the one that I've seen most of my clients and most people just in general mess up the worst. I've had more clients tell me that they've lost out on hundreds of thousands of dollars because of this one big mistake. It's seriously such a simple thing, but more than half of investors mess this up every single day.
20th century, it was an unbelievable century for the United States. If you take the whole 100 years, it went up 180 for one. Every $1,000 became 180,000. But 43 and 3/4 years were those three big, huge bull markets, and 56 and 1/4 years were periods of stagnation, all in an economy that was doing fine. 56 and 1/4 years, net, the Dow was down a couple hundred points during that period, and the other 43 and 3/4 years made up the rest of this move from 66 to 11,000 some on the Dow. So how could it be that you could have a country that was doing better and better and better and better? Every generation was living better than the one that preceded it, but you had these huge changes, big gains a few times, long periods of stagnation. 20 years, I mean, that's a long time to do nothing. The answer is that investors behave in very human ways, which is they get very excited during bull markets and they look in the rearview mirror and they say, I made money last year, I'm going to make more money this year, so this time I'll borrow. Or the neighbor says, I wasn't in last year when that neighbor was dumber than I made a lot of money, so I'm going to go in this year. So they're always looking in the rearview mirror. And when they look in the rearview mirror and they see a lot of money having been made in the last few years, they plow in and they just push and push and push on prices. And when they look in the rearview mirror and they see no money having been made, they just say, this is a lousy place to be. So they don't care what's going on in the underlying business. And it's astounding, but that makes for huge opportunity. Just huge opportunity. You know, you will see things you won't believe in your lifetime, and securities markets. The country will do very well over time, but you will see these huge waves. And if you can stay objective throughout that, if you can detach yourself temperamentally from the crowd, you get very rich. And you won't have to be very bright. I mean, I'm sure you are, but it doesn't take brains. It takes temperament.
It doesn't take brains, it takes temperament. Every year there's a new headline or news story telling us why this is the worst year to be investing, and there's going to be a huge dip, and you're going to lose all your money, and the S&P 500 is going to get cut in half. This last year is because of the election and the rising inflation. Analysts everywhere were saying, brace yourself for the biggest dip in the history of dips. And all the while, we hit like 20 all-time highs this year. Unfortunately, I know many people that took 7 figures out of the market right before 2024 in anticipation of what might happen, and they lost out on about 30% gains. The S&P 500 went up 30% or so in that time period. On $1 million, that's a total of $300,000 that they missed out on by selling out. When in doubt, zoom out. Look at the S&P 500 full chart and look at all the storms it's weathered in the last 90 years, and look how it's always gone right back up and surpassed it. Keep your emotions to a minimum and stay the course. So this next rule, and number 4, is one of my favorites. It's just so amazing to me that when the stock market's down, nobody wants to jump in. But when it's going up and the prices are actually at their highest, that's when everybody's excited to jump into the market. So people didn't like VU when it was $400 per share, but right now that it's up way over $500 per share, people are buying it hand over fist. With this logic, it would be like going into a store and finding a hat that you really, really like, but looking around and nobody else really wants this hat. And you ask the store owner, how much is the hat? And he says $30. You say you'll think about it and you come back another day. Come back a month later and now a bunch of people want this hat and the store owner says, okay, cool, it's $50 now. And for some reason, because other people want it and because it's more expensive, you decide to buy it. In investing, that's a sure way to lose money, or at least lose out on the possible gain. Rule number 4 is to be greedy when others are fearful, and fearful when others are greedy.
Behave very peculiarly in terms of the reactions, because they're human beings, and they get excited when others get excited, they get greedy when others get greedy, they get fearful when others get fearful, and they'll continue to do so. And you will see things you won't believe in your lifetime. And securities markets. I wrote an article for Forbes in 1979. I just said, how can this be? Pension funds in 1970 put 100 and some % of their new money in stock because they were wild about stocks. Then they got a lot cheaper and they put a record low in, 9% of their net new money in 1978 when stocks were way cheaper. Investors behave in very human ways, which is they get very excited during bull markets. And when they look in the rearview mirror and they see a lot of money having been made in the last few years, they plow in and they just push and push and push up prices. And when they look in the rearview mirror and they see no money having been made, they just say, this is a lousy place to be. So they don't care what's going on in the underlying business. And it's astounding, but that makes for huge opportunity. Just huge opportunity.
This is only going to be possible if you do the research. You won't know any better if you don't do your own research. You won't know if the hype is worth it. You won't know if the stock is down or the market's down because of some other reason. And because of that, you're going to lose a lot of money, or at least lose the opportunity to buy in at the right time so that you can make a lot more money. Use my channel as a reference points to get you started in your research. But make sure to go deeper than anything I or any other YouTuber or blogger says. Watch either of these 2 videos to keep you going strong and continue that research, and make sure to remember to keep investing simplified.